Welcome back to the channel, Financial Navigators. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeeze scenarios. We're going to examine a very specific company that has popped up on our radar with some truly eye-watering borrow fees. This isn't generic advice, we're going straight into the nitty-gritty of Big Tree Cloud Holdings Limited, ticker symbol DSY. Get ready to understand what makes a stock hard to borrow and why that can sometimes, but not always, be a signal for fireworks. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about DSY, Big Tree Cloud Holdings Limited. This company operates in the consumer defensive sector, specifically within household and personal products. With a market cap of around $13.07 million, it's a micro-cap player. Big Tree Cloud Holdings manufactures and sells personal care products and other consumer goods, including sanitary napkins, panty liners, and sanitary pants, under brand names like Big Tree Cloud and Yalyurt. Show company logo/product images. Looking at the recent price action, DSY has been quite volatile. Today, it saw a modest increase of plus 1.59%. However, over the last 5 trading days, it's actually down minus 14.69%. But zoom out to the last 30 days, and you'll see a significant move upwards, with the stock gaining a remarkable plus 59.72%. This kind of sharp run-up often attracts short interest, and that's precisely why DSY is on our screen today. What is cost to borrow and why it matters? Before we get further into DSY's specific situation, let's break down cost to borrow, or CTB. When an investor wants to short a stock, meaning they bet its price will go down, they first have to borrow shares from a broker. Just like renting a car, there's a fee associated with borrowing those shares. This fee is known as the cost to borrow. It's typically expressed as an annualized percentage. Why does it matter? Because a high cost to borrow is a direct signal that demand to short a particular stock is extremely high and the supply of shares available to lend out is very low. When these fees climb above 100%, it means the daily cost to maintain a short position is becoming incredibly expensive, putting significant pressure on short sellers. Why this stock is hard to borrow right now. Now back to DSY. This stock appeared on our hard to borrow screener for some compelling reasons. Prepare yourselves for this number. The annualized cost to borrow fee for DSY is a staggering 701.7%. Highlight 701.7%, that's not a typo. To put that in perspective, a fee over 100% is considered extremely high. 701.7% is in a league of its own. What's more, this isn't a static situation. The CTB momentum for DSY has surged by plus 80 percentage points just over the last 5 trading days. This tells us the cost to borrow is not only high, but it's rapidly getting even more expensive. Adding to this, the shares currently available to borrow are incredibly scarce, a mere 10,000 shares. Considering DSY has an estimated float of 1.3 million shares, 10,000 available shares is a tiny fraction. This severely restricted supply, coupled with skyrocketing demand, is what's driving that extreme cost to borrow. Our internal composite squeeze score for DSY currently stands at 43.7 out of 100, indicating a notable level of potential, but certainly not a guarantee. Let's also look at the volume. Today's volume for DSY was just 17,000 shares, a stark contrast to its 30-day average volume of 5,785,520 shares. This translates to a relative volume of 0x average, meaning trading activity today was almost non-existent compared to its recent average. Low volume on a date where borrow fees are astronomical is a setup worth observing closely. Squeeze mechanics explained. So, what happens when a stock like DSY becomes this hard and expensive to borrow? This is where the short squeeze mechanics come into play. Short sellers make money if the stock price falls. But if the price starts to rise, they start losing money. With a CTB fee over 700% and rapidly shrinking borrowable shares, short sellers holding positions in DSY are facing immense daily costs and increasing risk. At some point, the pain of these fees, combined with unrealized losses from a rising stock price, can become unbearable. When this happens, short sellers might be forced to cover their positions by buying back the shares they initially borrowed. This buying pressure, especially if a lot of short sellers cover at once, drives the stock price up even further. This rising price then triggers more short sellers to cover, creating a rapid, self-reinforcing upward spiral that's a short squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the stock's price will eventually fall, and they are willing to pay exorbitant fees to maintain their bearish bets. Dilution risk check. When evaluating a short squeeze candidate, we always check for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Why is this important for a squeeze? New shares can be used by short sellers to cover their positions, effectively providing liquidity and offsetting the pressure of a shrinking borrower supply. Fortunately for DSY, we found no recent dilutive SEC filings such as -1s, -3s, or 424BS in the last 90 days. Also, our check for a reverse split in the look-back window also came back clear for DSY, which is another factor that can sometimes impact short squeeze dynamics. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For DSY, here's what to keep an eye on if you're tracking this stock. First, continue to monitor the cost to borrow fee and the number of shares available to borrow. Any further increases in CTB or significant drops in borrowable shares would intensify the pressure. Second, watch for sudden, significant spikes in volume, especially if they are accompanied by strong upward price movement. This could indicate short covering is beginning. Third, observe key technical levels. A strong move above established resistance could be a trigger for more buying. The key question is whether any upward price action is due to genuine buying interest or forced short covering. The Treecode Holdings Limited (DSY) presents a fascinating case study in the hard-to-borrow space. With a truly extreme 701.7% cost to borrow and only 10,000 shares available, the pressure on short sellers is palpable. While the potential for a squeeze exists, remember the risks involved and that high borrower fees do not guarantee a specific outcome. Understanding these mechanics is vital for anyone looking to navigate these unique market situations. If you found this deep dive into DSY insightful, please hit the like button, subscribe to the channel for more unique educational content, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.